Good morning. My name is Adishan Naidu. I'm from the Global Markets Retail Investment Team. I'm joined once again by Tom Gale, Executive Global Markets Standard Bank Trading. Tom, good morning.
Good morning, Adi.
Well, we know we've had the 4th of July and some fireworks, but a lot's going on in the markets at the moment. Last week, we started off with a bit of caution. What do we expect to see? Is it still that way, Tom?
Yeah, so that's right. Having been very constructive on the way back up for markets globally, as you rightly say, last Monday we just turned a little bit of caution. Um, so first of all, given how much markets have rallied, and then secondly, premised on the cluster of risk that sits in the month of July for global markets. Some of this will be familiar to you and your audience. We saw on Friday, on July 4, Independence Day, the US president sign into law that one big beautiful tax bill, and it effectively extends temporary tax cuts that Trump enacted in his first presidential term, and it also adds some new tax cuts. It cuts back on spending, on federal spending, but not as much as the tax cuts pull back on revenues. And so, in as a net result, the Congressional Budget Office, which is a non-partisan economic and financial analyst, has argued that the bill will add over the next 10 years over $3 trillion of additional debt, federal US debt. And wrapped up into that same bill was an increase in the US debt ceiling, which allows the government to continue borrowing and therefore to continue paying its bills, lifting that ceiling to over $41 trillion. So big numbers, makes your eyes water.
Yeah, it does.
We had had some concerns for several months coming into this, because if investors start to fret and get anxious that the US is moving towards a position of greater insolvency risk, increases debt, its debt service costs rise, and perhaps it eventually struggles to pay its debt, then you would see that first and foremost in US bond yields, and the performance of US bond prices will come onto that. At the moment, the market is okay. There's no big wobble. Markets in the US were closed on Friday anyway, have reopened this morning. US yields on treasuries are a little bit higher, but there's no panic. But I'm still going to tread with a fair amount of caution. The other reason
that ties into what you're saying, because if you look at the US futures, Dow and the Nas, all are trading quite down at the moment. So I think caution to the wind is the right call at the moment.
Well, indeed. I mean, the other reason why those futures are trading lower is, of course, because this is the week when we hit a deadline on that 90-day tariff pause. In other words, tariffs could come back this week. The Treasury Secretary in the US, Scott Bessent, did announce that tariffs, if and when they are reimposed, would actually only now be effective from the 1st of August. But let's not lose sight of the point here, which is that if you're from a country that has not concluded a trade deal with the US, then you are going to face the reimposition of tariffs. I might also just add a footnote that even if you have done a trade deal with the US, you're still going to be stuck with a baseline 10% tariff. And generally, that kind of trade friction and increased cost of trade is not good for economies, not good for markets. So that's another reason that I'm cautious, and that we've had a little bit of these risk events clustered in this early part of July. Add to all of this, again, your audience will be familiar with the headlines by now that the BRICS summit that convened in Rio de Janeiro over the weekend, and of course it included South Africa as the S in BRICS, was then threatened by Trump for anti-American posture with an additional 10% of tariffs. So we're back fairly and firmly and squarely into difficult tariff territory. Before we move on, I'll just add that there's been another increase in oil production announced by OPEC, the third straight production hike, and that will put a little bit of downwards pressure on the oil price, but I don't think we need to talk to that one today. I think if we're talking about the risks, the caution that I'm expressing for markets globally, and bear in mind, for example, that the S&P, which has been making new record highs, as you know, up some 25% from those April lows, huge rally. You may just want to consider looking at some other markets that offer a little bit more value, and it would be timely here, I think, just to mention our China multiplier. The Chinese market does offer some good value, and it's certainly a lot cheaper than US markets on any given multiple. We are launching, and in fact we're soon to close the book on our China multiplier, which offers you uncapped participation over a 3.5-year time period for MSCI China, but you'll have your capital fully protected over that time. So if the Chinese market were to go down over 3.5 years, you'll have your capital fully protected.
No, that's correct. And I mean, that closes, as you mentioned, on Friday, the 11th of July, and it's about 25,000 minimum investment amount. So I agree with you. It is worthwhile looking at, because it's a capital protected, to your point, given the uncertainty, and it's got a nice upside. So given the fact that it's in the framework, and the fact that there's a framework as well for tariff for China, it's not a bad trade-off to think about.
Yes, you talk about a trade framework put in place between China and the US. That is indeed the case. They do need to thrash out some of the details still, and it will be a fractious road for the two of them. Of course, there'll be bumps in the road, but over 3.5 years, there's good value certainly in 100%. The Chinese market.
100%.
The US market is certainly playing with fire. I'm going to share a couple of slides as we go that risk getting a little technical. I don't want to veer too much into detail, but the point about the big tax bill that has raised the ire of people like Elon Musk is that it, as I say, it adds debt. It doesn't fiscally consolidate. It actually adds to the national debt pile. And to put this in historical terms, because when we talk about numbers like 41 trillion, some of us just cannot comprehend that. It doesn't quite sink in. So let's put it in historical terms. In the next 4 years, again, according to the Congressional Budget Office, which is a non-partisan analyst, the US debt pile will surpass the previous high made in 1946 in the aftermath of the Second World War, when, of course, the Americans fought a very costly world war. Now, that's where we are without World War, and so the end result is that the US is going to have to service this debt pile, and the cost of the US servicing this interest cost is going to be twice what it's spending on its federal government bill in the next 10 years. So it's becoming incredibly difficult for the US to carry this amount of debt. I'm borrowing a couple of charts here from the Financial Times, as usual, the #1 newspaper for delivering market insight globally, and they have crafted a couple of charts that show that yes, if the trade tariffs are implemented, that means when the US imports goods from around the world, they will be they will have a tariff put on them at US customs as they come in. That import tariff will be paid by the importer in the US, in other words, by US businesses and US consumers if they can ultimately consume those goods. So Americans pay for the tariffs, but what it does do is put money in the coffers of the federal government. And you might hear some analysts arguing that that will help pay for some of the higher budget deficit, for the higher interest costs that the US is running. Well, as you can see on these charts, especially the one on the right, where it shows so far duties received on the first month or two of US tariffed imports, but it's really dwarfed by the size of the fiscal deficit. So it doesn't entirely pay for running a budget deficit. You might also hear some analysts arguing, like the White House think tank, the Council of Economic Advisors, that these tax cuts in the US will drive higher economic growth, and that in itself then will pay for the costs of federal spending. Well, that's possible. We simply don't know if that will be the case. But the numbers that have been put forward by the Council of Economic Advisors of 4.2 to 5.2% higher GDP in real levels in the short run, in other words, the next 4 years, is entirely unfeasible according to most non-partisan analysts. So just bear in mind that US growth could pay, but that's yet to be proven. The other thing that we saw last week in US jobs data was some very strong prints, and those job numbers actually forced the market to move away from pricing a rate cut in the US in July. So it could just be that the economy does remain on sound footing. We'll see, but in the end, it'll be for investors to decide. Investors in US bond market will decide if they want a higher coupon, if they demand a higher coupon, a higher yield for holding US debt. And you can see on this chart that US Treasury yields have been trending higher for the last 4 or 5 years. Just recently, circled in red, you can see they've just pulled back, which is why markets have made new highs. But I would urge you and your audiences to keep an eye on US Treasury yields. We'll certainly be bringing you that commentary. If these yields start to move higher again, that's going to be a big problem for the US market.
So a problem in terms of, we're seeing, just in the slide you're showing now, you're seeing our bond yields, and I know you're going to probably touch on it, come lower, but if those bond yields go higher to US points, what does that mean for US markets?
Well, certainly, if US Treasury yields are higher, that means the price of treasuries of bonds are lower. That means that bonds are out of favor, or that investors are demanding a higher reward for holding debt, riskier debt. When the US Treasury issues debt, which they do on a weekly basis, in fact, to the tune of something like $500 billion, those auctions of treasuries attract a yield. It will clear with investors, and investors will decide on the yield at which they clear. So if investors are demanding a higher yield, that simply makes the US government's ability to raise debt much more expensive. But you're right, the opposite is happening in South Africa, where we've seen yields actually come lower. So we've seen bond and credit yield compression, and that conversely is a sign of confidence in South African government debt. So right now, recently, it's been a much better landscape for South Africa. The dollar rand has edged a little bit higher. 1750 proved a big level. What I would just start off by saying is that we've been calling the rand to 17.5 for some time.
Yeah.
And we got there. It's proved a little bit of a tough level to break. There has been some hedging that we've seen, and then of course more recently this morning, concern around what Trump intends in terms of tariffs on BRICS nations.
But I ask you this question though, Tom. We did call, and I mean, you're 100% right. We've spoken about dollar rand. You've spoken about level 1750 for a while. But is this a case of, and I tie back to the two previous charts that you mean, is this a case of, as again, and we spoke about it in previous pulses, dollar weakness, rand strength, or combination of both?
Yeah, so certainly it's been a case of a weak dollar. You can see the dollar here in blue. The blue line shows how much the dollar has fallen. And therefore the dollar rand in white should have fallen in lockstep with it. It hasn't. So it's largely been dollar weakness. There has, in the last week or two, been a bit more confidence in the rand and rand assets, as shown in those yield compression charts I shared a moment ago. So there's been a big helping here for sure of dollar weakness.
So the reason I ask is exactly that for the audience, that if we start to see some dollar strength, and given what's happening locally or on onshore with South African markets, do we expect to see with dollar strength this 1750 level going back to 18, or can we hold again with dollar strength, given everything that's going on locally with the rand locally?
That's right. So what I want to come on to now is just a little bit of the local political landscape. The risks are just picking up again here for us. Again, you'll be familiar with the situation in the government of national disunity. More recently this weekend, there have been reports that Ramaphosa has threatened Steenhuisen with a charge of insubordination. We don't really know what that means, but certainly relations between the ANC and the DA in the government of national unity are at an all-time low. And if they continue in this way, it could come to a head. The ANC's National Executive Committee could convene and resolve to force the DA out. That's not inconceivable anymore. So we are watching this particular sensitivity very closely.
All right.
Another reason why there is some risks building again is that there's another sanctions bill being introduced to the US Congress, this time by a gentleman by the name of Greg Stoiber, who is citing hostile and anti-Semitic conduct by the Republic of South Africa. And so there are now two bills in the US Congress urging sanctions, US sanctions on government and ANC officials. Now, we don't hold out a high probability of these succeeding in the US Congress, but again, this will require close monitoring because these do represent a lot of risk, especially alongside the tariffs that we're seeing, as I said, applied to BRICS nations. So we started off, you reminded me of a point I made last week where I said I'm turning slightly cautious on markets, and that is absolutely the case. It doesn't mean that markets can't go up, but it does just flag that the risks are slightly outsized to the downside here, given how much we've now rallied and given how this cluster of risk events is coalescing here in July. We are still broadly constructive on South African equities, but we would be very careful about our stock picking. We are still positive on platinum group metals, and indeed Shanghai Platinum Week got underway today in China, and we'll deliver another very bullish message on platinum. So to remind you and your audience that our preference amongst the PGM miners is for Northam. That's where we have a buy and we have a hold on Valterra. Impala is our least favored. I also might just remind you that amongst some of the local stocks, well, we are positive still on Life Healthcare. And we have a buy on that stock. They have some fairly ambitious bed capacity expansion plans. So On this one, we've applied a 17 rand price target. In the banks, South African banks, we're still very positive on both Capitec and Standard Bank. We have buy recommendations, both sitting on fairly depressed valuations. So there's still some relative value in at least two of the banks. Raynet, maybe one that your audience is familiar with, had a very big rally last week on the agreement at last, finally, to sell their pension insurance group stake. We downgrade that one to a hold. So if your audience is wondering whether there's still some upside in that share price, no, we would be a little cautious on that one right now. So broadly speaking, we're into some difficult territory for the next week or two for global and for South African markets, but there are opportunities, as there always will be, and the Chinese market could be one of those. So too will be the South African market over time. It still remains very cheap compared to, for example, the US market.
Well, that wraps it up quite nicely. And I mean, just in elaborating on that, you said that we've seen a lot more opportunity in SA. So we should, in my mind, see more of an upside on the South African equity market versus the S&P and the offshore or the US markets over the next few months.
Well, that's true. Yes, over time, that's absolutely true. We traded a significant discount still, South African stocks on a historical look back. But as I say, we're just mindful of a number of the risks that are building now in the short term. There may be better entry points.
100%. Well, Tom, thanks so much for today.